Hello and welcome everyone to Stanford Law School and our last Rock Center evening event of 2014. My name is Evan Epstein and I'm the Executive Director of the Rock Center for Corporate Governance, which is a joint initiative between Stanford Law School and the Stanford Graduate School of Business. First of all, I have to say it is a pleasure to close this year with such a full house and a fascinating panel discussion. Somehow we have a knack for building these high-profile events at the end of the year. A year ago, almost to the day, we hosted another panel to discuss Bitcoin, and both events have been totally oversubscribed. So I don't know if there's a connection there, but both have been oversubscribed. It's been a busy year for the Rock Center. We have conducted and funded a lot of core research on corporate governance issues and hosted dozens of seminars, programs, and events around these topics, both in the United States and abroad. But tonight, our last Rock Center Evening Speaker Series event of the year, traditionally hosted on the second Monday of every month. Our next event actually will take place on Monday, January 12th, on the topic of control corporations and dual-class share structures. We'll have an interesting set of panelists, including former Delaware Supreme Court Justice, so please look out for the announcement. But today we have a tremendous panel to discuss Berkshire beyond Buffett, the enduring value of values. We should thank both Brian Tan and Professor Larry Cunningham for bringing up the idea of hosting this panel, and they have both conducted significant research on Berkshire, and Larry has just published a book on the subject that has been critically acclaimed, and you may have seen it available for sale outside of this classroom. So it is a privilege to have them talk about this research along with outstanding experienced practitioners such as Susan Decker, Tom Russo, and Brad Kinstler. So thank you, Larry, Susan, Tom, and Brad for coming to Stanford to talk on the subject. We are obviously extremely lucky to count with such a talented panel. So please help me in welcoming my GSB colleague, Brian Tan, who will introduce our panelists, and then we'll kick it off for the discussion. So thank you.
All right, great. Thank you. Can everyone hear me if I speak from here? Okay, great. Perfect. Well, thank you, Evan, for having us. First of all, I want to say thank you all for coming. I know in December on a Monday evening, sometimes sitting in a classroom is not everybody's first idea of a fun time, but we really appreciate your coming, and we hope that through this discussion you get some insights into the company, Berkshire Hathaway, that really gives enduring lessons for you. So I first want to give a brief introduction. The four panelists here: Larry Cunningham, who's a professor of law at George Washington University. He's also, as Evan mentioned, the author of Berkshire Beyond Buffett, which is outside for sale. Susan Decker, who is a director of Berkshire Hathaway. Brad Kinstler, who is the president and CEO of See's Candies, which is a subsidiary of Berkshire Hathaway, a wholly owned subsidiary. And Tom Russo, managing director at the investment company Gardner, Russo and Gardner. Tom is a graduate of the JD and MBA programs here at Stanford, and he is also a longtime Berkshire investor. So between these four individuals, we will have various viewpoints into this company. So the way we're going to do this is I'm going to quickly go through 3 or 4 slides. I come from the business school side of things, so it's mandated that we have some PowerPoint. And then at the end of that, I will ask them some questions. And at the end of that, then we will invite you to come ask your questions as well. So first, I wanted to start back in 1984, which is when Tom was a young JD MBA at Stanford. At the time, these were the largest companies in the United States. Number 1 was IBM, which had a $75 billion market cap. Number 2 was Exxon at a $35 billion. GE was next at 26, General Motors at 25. This was before the bankruptcy. And Shell, which is 17 billion. And you have to go way down the list. It's hard to get an accurate count, but Berkshire Hathaway had a value of $1.5 billion. This is the market cap of the company. We had to do some interpolation because our lists at the time didn't go down that far. Somewhere around 140th largest in the United States. So if you fast forward to today, this was at the beginning of the month. Apple was the largest company, 672 billion. Exxon just under 400 billion. Microsoft neck and neck. It's actually passed in the last couple of days. Google at 365. Number 5, Berkshire Hathaway, $360 billion company. Over that 30-year period, it's grown 240-fold. And now if you give a comparison, Exxon, which is a highly reputable company, not shoddy in any ways, has grown 11 times. So from the investor standpoint, over the 30-year period, Berkshire Hathaway, if you had purchased shares, has grown at a compound annual rate of just south of 18% per year. And if you had instead invested in the Standard & Poor's Total Return Index, which reinvests dividends, you would have a return of approximately 8% a year. So a 9 percentage point per year difference compounded over just the 30 years. And Buffett and Munger obviously started at Berkshire Hathaway 19 years prior to this measurement date. So that graph's not even worth showing. But you would have tenfold more money had you invested in Berkshire at the beginning of that 30 years, which is why Tom is here. Here's a very brief overview, which is very hard to read, but this gives you a sense of the vastness of the operations of the Berkshire Hathaway Company. This is taken directly from the annual report. There on the top lists insurance companies. There are 12 insurance companies, and then the whole bottom of the page are the non-insurance subsidiaries. The obvious, most well-known insurance subsidiary of Berkshire is Geico, which I'm sure you've all seen the ads, and probably somewhere around 10% of you have your insurance through Geico. General Re and Berkshire Reinsurance are the largest reinsurance operations in the United States, in the world, I should say. And those are subsidiaries. And on the bottom, there are just many esteemed brands. The ones that would be familiar to many, obviously Acme Bricks, Benjamin Moore Paints, Burlington Northern Santa Fe, which is the second largest railroad system in the United States, Justin Boots, Fruit of the Loom, and of course, most importantly, See's Candies. So, and I know you can't read these numbers, so I wanted to highlight, just so you can see this, there are 36,000 people who work for Berkshire's insurance operations. And for the non-insurance operations, 294,000. This certainly puts them in the largest, among the largest employers in the United States. That's north of 300,000 people. And the people who oversee this in headquarters, 25 people. So Mr. Buffett is one of them, and Mr. Munger is one of them, and the other 23 people. And together, these people are responsible. Now, this ratio of corporate overhead to company assets is by far the most extreme that you will see in any business setting. So one of the questions that's very interesting is how this works. So finally, let me just run through what these assets are. They're very big numbers. You have $332 billion in insurance and other subsidiary assets, $151 billion in railroads, utilities, and energy assets. Financial products, which are mostly leases and mortgages, a small portion, $34 billion. Total 517. And if you break this down, the insurance down into kind of the liquid portfolio that Mr. Buffett is famous for having, $56 billion in cash, $29 billion in bonds, $116 billion in publicly traded stocks. The most well-known are Wells Fargo, American Express, IBM, and Coke, and $13 billion in other, which are mostly preferred. So liquid, we'll call it portfolio of $214 billion. So I think the question we want to know is, how did we get from a very small number to such very large numbers, and how are these very large numbers managed? And I think what we're going to do is we're going to start with Tom. We're going to wind up back to 1984, where our story here begins, when Tom was a young JD MBA. He was in Professor Jack McDonald's very well-regarded investment class here, and Mr. Buffett came to class. And what did he say to you when he walked into class?
Well, he said good morning to Professor McDonald and thanked him for inviting Warren to come. And I was delighted to be in that class. Stuart Klein and Professor McDonald are here. And I would attribute so much to what's happened to me as an investor to that experience. And so it was fabulous. I would say the refrains that Warren touched upon at class in 1982, I think it was, are really the same thing he still talks about today. And he had the same message every year when he talked to students and talked to the annual meeting crowd for nearly 30 years. And it's the recurring nature of what he said through times when everything surrounding has changed so vastly that was so reinforcing. It's a steady message, and everyone knows about the standard message. The one I thought was most unusual about the year he spoke to our class was that he said all the standard investment stuff, but then he said when you're making investment, you have to understand one thing: you can't make good deal with a bad person. And he really was talking about agency costs and the need to be able to trust was something that as early as 1982 he was talking about. And agency costs is really a huge problem with public market investing in general. And it's ironic that Evan said that next week there's going to be a session on controlled companies and dual class shares. Well, I count something like 45% of the assets that I oversee are dual control shares, not the least of which is Berkshire Hathaway, which is about $1 billion investment on behalf of my clients. I think that actually the power that's conferred by control/dual class in the right hands is what gives management of a company like Berkshire the chance to really hit the ball out of the park, because they're able to take steps that if there was an open share registry would make them vulnerable to activists and to takeover guys and all this stuff. But that dual class in the right hands, so I won't be here next week, though I'm tempted to stay over, but I hope you put in a plea for the continued existence of them, because I think they're quite valuable. And
So,
in the case of Berkshire, they would have been part of the story, I think.
let me ask you, when did you first purchase shares as an investor?
It's a very,
And did you purchase because of Mr. Buffett or because of Berkshire?
no, it's a very good question, because I remember after the class, I spoke to Professor McDonald's afterwards and said, thanked him very much. It was the most enlightening class ever. And I said, the only thing is, it's gone up a lot. You know, it was $300 3 years ago. It's now $1,100. I just don't know. And Professor McDonald said, Tom, you're not nearly as attentive as I thought you were. Just buy it. And it had gone up threefold in the prior 3 years, and yet that's about where it was when I was a student, and I think that's where we first bought the shares.
Now, Brad, at the time when Tom graduated and he started in the investment world, you started in the insurance world. So can you tell us, what was your first job at Berkshire?
My first job was in Omaha at an insurance company that's still there, Cornhusker Casualty Company. It's a good name for a Nebraska furniture or a Nebraska company. It's not a good name for a Texas insurance company. So, but it does work well there. And at that time, I was brought into Berkshire by Mike Goldberg. Mike headed up all of the Berkshire insurance entities and reported to Warren. And Mike had been at McKinsey. He was a guy who ran the Pacific Stock Exchange, and he had his particular ideas about how insurance companies should be run. And Mike did not come from insurance. It wasn't his background. And he wanted to bring people in that looked at the insurance business as a business and would make decisions about that business in a different way than the typical tenured insurance person would. So Mike brought in a few of us. Probably the most interesting one he brought in was Ajit Jain. Ajit runs our reinsurance business, and for those of you who have been following what happens at Berkshire over the years, you know Ajit is the guy that has developed a tremendous amount of value for the Berkshire shareholders. And Mike knew Ajit from his days at McKinsey. He also brought in Don Worster. Don runs National Indemnity, our oldest and basically our largest insurance entity prior to Geico. And Don has run that since probably mid-'80s now, and has done a fabulous job in developing National Indemnity that writes a lot of difficult risks, long-haul trucking, those kinds of things. And then Mike brought me in, and again, not knowing insurance at all, he assigned me to Cornhusker Casualty and gave me basically the opportunity to move up into the management chain of Cornhusker by learning the business. And I started off on the claims side of the business. We wrote property casualty insurance, some small automobile commercial property, those kind of risks. And I learned the business from the ground up at that point, and within within a year or so, then I was assigned a little higher job within Cornhusker, and eventually got assigned some duties at Kansas Fire and Casualty, again, a good Kansas insurance company, but not good in Texas, and Continental Divide Insurance Company, which is a Denver-based company. So that was my start in Berkshire and in the insurance business.
And then you have an unusual background because most of the subsidiary CEOs stay within the companies that they either grew up in or sold to Mr. Buffett. Now you've moved across subsidiaries. You moved to the uniform division, the Fetchheimers, and you moved to See's Candy. Now how did that happen? And what were the conversations that you had with Mr. Buffett about these assignments?
Well, as I had told Larry at the annual meeting a while back, they keep looking for something I can do. And, so, at that time, Mike Goldberg, who oversaw the insurance businesses, also was assigned some additional duties. One of those was Fetchheimer Brothers, one of our uniform business out of Cincinnati that makes public safety uniforms and postal uniforms, military. And they'd had some turnover at the top of that business. And Mike asked me if I would go out to Fetchheimer and oversee that business that had a few manufacturing plants here in the United States, a very broad dealer network. And so I went out there and enjoyed Cincinnati. And within, I guess it was 6 or 7 years, that I got the call that Chuck Huggins, who had run See's he'd been with See's for about 50 years and had run it since 1972 when Berkshire bought it. And Chuck was retiring in 2006 at the age of 80. He'd kind of earned it. And so they needed somebody to come out and take over See's Candy. That didn't take me long to say yes to that, to come back to California where I'd run one of our insurance businesses. And you can't get a better brand than See's Candy. And so it's a great company, great opportunity. And so I've been fortunate to have some great experiences with Berkshire in different companies.
Great. Now, Sue, you started as an analyst at DLJ. Later, you were CFO and president of Yahoo. And currently, you're on the boards of Intel and Costco and Berkshire. And if I have my chronology right, you joined the Costco board first, and then you joined the Berkshire board a few years later, and then subsequently joined the Intel board. Oh, my question is about, I guess, first with the Costco board. Is that where you first met Charlie Munger?
Yes.
And what is he like as an individual?
I think what you see is what you get. He's curmudgeonly, but has a huge heart. And I think probably the private Charlie is a little less acerbic than the public Charlie. But overall, he's a very disciplined, curious, and passionate thinker, and loves business, loves the businesses he's associated with, and is a mentor and teacher at heart, just like Warren in many ways.
And how is it that you got invited then to the Berkshire board, and what was kind of the conversations that you had about joining that board?
Well, actually Intel was before Berkshire, so it was Costco, and that only plays a role. I only mention it because it did play a role when I first joined. So it's actually kind of an interesting story. I had been a student of Warren Buffett for many years as an analyst. I covered newspaper stocks and advertising stocks, and of course, Berkshire owned the Buffalo News in 100% of it, and I had a big position in Washington Post over the years. And on in my Wall Street days, I came out with a sell on the industry in 1986, and I had studied Buffett and was concerned a little bit about taking a counter view against someone like Warren Buffett, at that time not so well known, but I knew him well from reading, and so I remember trying to get my report in his hands through a friend of mine, and so I tried to meet him over the years, but had studied him carefully from my analyst days. And then over time, as time went on, one of the DLJ directors who was on the board of Costco asked me to join the Costco board, and that's when I met Charlie. And it was a complete surprise one day when Warren called me in my office at Yahoo, and my secretary said it's Warren Buffett. And I was having a meeting with somebody, and I figured it was a friend of mine playing a joke on me. But nevertheless, I picked up the phone and I said, Sue Decker, Warren Buffett here. And I said, oh my gosh. I said, I've admired you for years. He said, I've been admiring you too. And the conversation wasn't very long, but he asked me to become a director. And I had met him once at an Allen & Company event, but I didn't know him really. I think I knew much more about him than he knew about me. And I said, I would love to. This is a dream, but I'm already on the board of Costco, and I just joined the board of Intel, and I committed to the Yahoo board. I would only join 2 outside boards. So I need a little time to work on this. And I said, do you need to make a decision right away? And he said, well, if you're asking me if I have a plan B, I don't. So take the time you want. So it took me from that December all the way till 3 or 4 months to figure out a plan to make it work for the Yahoo directors, and then I joined at the next annual meeting. And in between that all, this is a cute story for you. I after that call, I was expecting some material, maybe the bylaws and information about the board, and it was around Christmas time, and I didn't receive it. He had taken I had heard my admin had given him my address, and I'm thinking, it didn't arrive. And then a few days later, by the side of my house where all these packages were accumulating because Christmas packages were coming in, there was a box from Berkshire. And in that box, it was a box of See's candies. And so began the wooing process.
And so what was your kind of the first board meeting like? And maybe tell people, generally who's on the board and kind of what are the dynamics of the board?
Well, the board, hopefully I'll remember them all. You can correct me if I'm
Help you out.
a good historian. So Tom Murphy, Don Keogh, Sandy Gottesman, Bill Gates, Ron Olson, Walter Scott, Charlotte Guyman, Steve Burke, Merrill Whitmer, Sue Decker.
That's it. You got them all.
Warren Buffett
And Howie
Buffett.
Yeah. The Buffetts.
That's who's on it. So it's a mix of individuals in every sense, age, geographically, business experience, everything. And what are the board meetings like? We have probably fewer board meetings than my other companies do. We have 2 in-person board meetings a year instead of 4 or 6, which is more typical. But the ones we have are much longer in duration in terms of mini meetings around them. So the actual formal board meeting is, not very long, in keeping with what a normal board meeting would be. But typically around the annual meeting in May every year, there are a number of events around that meeting, including the meeting itself, in which there's quite a lot of social activity among board members and families and extended sort of friends of Berkshire. And I think that's a important distinction. There's also a fall meeting, which Brad has presented. We have the managers of a number of the subsidiaries over a couple of days give a deep dive into their businesses and give the directors a chance to understand where their businesses are. And those kind of rotate over time. And again, families or spouses are invited. And so there's a strong inculcation of the culture that happens outside the board meeting, actually, that I think is different from my other boards. In terms of the formalities of the board meeting, they're not that different from any other meeting. The topic of the day at Berkshire, of course, is succession. That's a topic at almost any board, but probably the primary one our board focuses on.
We'll ask about that later. And Larry, you have the kind of important distinction of having edited Mr. Buffett's letters, and it's a book that I'm sure a lot of people here have read, and certainly every major school uses them in investment classes. How did that project come about?
Right, so he's referring to the essays of Warren Buffett, Lessons for Corporate America, and it came about 20 years ago, which was about 10 or 15 years after Tom took took Jack's class, so I was late to this party. But I was impressed with how unusual Berkshire Hathaway is in so many ways. My primary field is corporate governance, and it struck me about how unusual the governance structure at Berkshire was and is now. I mean, Susan has just summarized a little bit of it. They, at that time, especially, had very few independent directors. The decentralized structure meant that they had very limited internal control systems. They had a centralized auditing function, but not much else, and yet it worked very well. And so I began to research the company for its governance peculiarities, and I discovered it was also very peculiar when it came to investing, and when it came to acquisitions, and when it came to thoughts about taxation, and just about in every other way. So I decided, I can't really write this project myself. I should have a conference. And so I convinced my dean to fund a 2-day symposium featuring all of Warren's letters that he'd written over the prior 20 or 30 years. And I reached out to Bob Denham, who's a mutual friend and a partner of Charlie Munger's law firm, and asked him if he would help me introduce this idea to Warren and see if he would participate. And lo and behold, Warren called back a few weeks later and said, "This is Warren Buffett. I'd be happy to participate." So we had this wonderful event. Warren participated from the front row very actively, along with Charlie, engaging in the debate with 6 different panels on all those topics: governance, investing, accounting, taxation, and so on. And it was the most riveting set of conversations. Ordinarily, you have people in these, or often you have people in conferences like this just talking past each other. But here there was total traction. I mean, just people who believe in director independence really engaging with why Warren isn't so enamored of that. People who devoted their scholarship to proving that markets are efficient, engaging with Charlie about the foolishness of beta. It was just one of the most intellectually stimulating conversations that I've ever seen. And so we published the letters as a collection, organized thematically along those lines. We called it The Essays of Warren Buffett, Lesson for Corporate America. Now, at that time, Warren had just turned 65, and so people had just begun to wonder what would happen to Berkshire Hathaway after he was no longer around. And we debated this topic right in front. He was sitting in the front row with Charlie. Ajit Jain was also there. Howard was there. His late wife, Susie, was there. People talking about what will happen after he is gone. People debating what trait would Berkshire miss the most, and would the stock price fall or rise, and all of this sort of thing. And Charlie finally said, "Look, we've had enough of this conversation. Not everyone in this room feels this is a comfortable conversation to have." And Warren said, "Don't worry about it, Charlie. But let me tell you one thing that's for sure: it won't be as bad for the stockholders as it will be for me."
So, and then let me ask about, in 1983, Mr. Buffett writes something called his operating principles. And this is something he publishes. He distributes it again when they purchase General Re, because there's this whole new class of investors that join, and he wants them to know what it's like to be a shareholder in Berkshire. And now subsequently it's included in the annual report. What are kind of the basic tenets of these operating principles? What do they say?
So it's the owner's manual, and it's a very simple set of propositions. There are 15 now. I think there were 12 in the beginning. We've added 2 or 3. The first and most fundamental, I think, is that Warren and Charlie and I think the board and others conceive of Berkshire Hathaway as a partnership, despite its corporate form. That is, it's not hierarchical in the traditional corporate sense with a board of directors and a managerial group and a bunch of shareholders, but rather it's a community of co-investors in a long-term project. And that spins out into attracting a group of shareholders who share that sensibility, who share the sense that we have all purchased equity in a long-term enterprise. And so one consequence of that is that Berkshire shareholders trade in the stock relatively little, even today, with 1 million shareholders, including those picked up from the acquisition of BNSF and others. The turnover rate in Berkshire stock is a fraction of what you see at other conglomerates, at other insurance enterprises, at other industrial companies of its scale. And I think that's the most important one. A second unusual one is it takes a very unusual approach to distributions. All that enormous cash sitting on the balance sheet and that immense liquidity Berkshire has never paid a dividend in 49 years. I think it paid a dividend the first year Warren took control of it and hasn't paid a dividend since. And it has a very unusual test for deciding whether to make a distribution or not. And the question is whether the company can do better retaining a dollar than the holders could. And he proxies that by whether he could invest a dollar to increase the market value of the stock by $1. And spectacularly, the company has been able to achieve that for its stockholders. But I think that owner's manual, as he calls it, is a remarkable document for its existence. I can't think of any other company of a public company like this that has an owner's manual that conceives of itself as having a partnership with its owners. So above all else, if you don't have time to read deeply into Berkshire Hathaway, that's a quick and delightful way to get a sense of what he has tried to achieve at Berkshire, and I think what he has achieved.
Well, and Tom, I'm going to ask you on that same line. Larry says in his book about these operating principles in the owner's manual, he says these principles reflect that Buffett has always been a shareholder first and a manager second. And I wonder what the significance is for you as an investor.
Well, I would say the interaction between shareholder and manager is really quite interesting within Berkshire, because Warren will frequently say he's a better investor because he manages businesses, and he's a better manager of businesses because he's a public market investor. And Larry could say whether that's part of what you're referring to there, but at least from my perspective, what's most unusual is in business, typically you have silos, and Warren exists outside the silo. He does manage companies, and he does manage portfolios, and within portfolios, he is free to look at fixed incomes, preferreds, common stocks, wholly owned businesses. And I always have a sense that Warren has the great virtue in running Berkshire of being willing to do anything and able to do nothing. Able to do nothing is really underrated, and most people can't do nothing in the investment world. They feel that there's a burden to do something, and he always says, they don't call strikes in investing, and he has the privilege of operating secure in his corporate control, that he won't be chastised by owners who want more from him, and that's made all the difference, I think, over time.
Now, and you go to the annual meetings every year.
Yeah, it's a sort of a resetting of those important principles, and you spend the next 12 months forgetting them. And then you go back and sort of remember them, and you meet great people, and you see your friends, and so it's a mix of reasons.
Well, I guess that's my question. Why do people go? I mean, first, give people a sense for how many people. The first time you went, how many people were attended, and this last year, how many people attended, and why do people go?
I would think the first year may have been 300 people. It was less. It was in probably 85, and it was before they moved to the Joslin, so it would have been still pretty small. And this past year, it may have been 43,000. It's not small at all now, but they still over-deliver through their comments from the bench in a way that makes it very worthwhile.
And so why is it that people go? I mean, it's mind-boggling that 43,000 people would go to fly to Omaha. A lot of people making connection flights coming from outside the United States to hear two people speak for 6.5 hours with a small break, but then enjoy a whole weekend. So why is it that so many people go?
I think from a professional investor's perspective, it's just resetting values, and then where else can you find this? This is a business that works well in practice, but it's terrible in theory. And people will describe to you on a regular basis why everything about it doesn't work in theory. But it's going there and then sort of resetting why it works in practice that makes it worthwhile. And then there's just an enormous amount of fun with the people who you may share some of that with, and they tend to be friends and long-standing. So,
by a show of hands, how many people have been to that meeting?
Great.
So it's a good group here that knows.
We'll boost the numbers next year.
Yeah.
So now, Brad, you have the honorable distinction of working at See's Candy, and Charlie and Warren both say that company taught them the value of a great business. And so can you tell us kind of the story of how See's came to be purchased from them, and what what that value is, what the lesson is that they learned from the company you now oversee.
Yeah, the C family had built the business to be pretty much what it is today. It's known for very high quality product, reasonable prices, and a value in boxed chocolates that is really very high. And as I understand it, that the C family had reached a point where there wasn't a member of the family that would continue in the CEO role, and they were willing to sell the business. And word got back to Charlie that C's Candy was for sale, and that was again 1972, and they did. Charlie was very familiar with it, loved the product, and I guess in talking with Warren, believed that they should buy the business, and they talked about a price, and I think it was initially $30 million or so for the business, and Warren and Charlie ultimately decided to offer $25 million, and I think Warren was willing to walk away if that price wasn't agreeable, and the C family took the price, and as a result of that, Berkshire has owned C since then, and that $25 million investment has become a company that annually sells $400 million of boxed chocolates a year, and is probably in the United States the highest volume boxed chocolate business in the premium sector. There's a few other chocolates out there that sell more because they sell through the drugstores, but when you look at premium boxed chocolates, it's C's Candy's the largest.
Now, Larry emphasizes in his book the principle of autonomy, and Charlie has said in the past he's described Berkshire as operating under decentralization just short of abdication. So, what does it mean for you to work autonomously within Berkshire?
It's just the way that Warren has always elected to run the businesses. It's not, and I think we're successful not because he tells the managers what to do, but it's what he allows us to do. That is the difference that you're going to get in Berkshire. That he is not involved in any of the businesses I've been involved in, and I think it's the same for all the other subsidiaries for the most part, that he allows us to make the decisions to run the business and develop that business as we see fit, and what in a way that we believe is most beneficial for the shareholders. And we understand clearly that is who we work for. It's the shareholders, the owners of Berkshire Hathaway, are what we're in business to make sure that they are satisfied. And what goes along with that is maintaining a balance between what's good for the shareholders, what's good for the customer, and what's good for the employees. And if we maintain that balance, produce the results that we expect to produce as a business, then everybody's happy at the end of the day.
Now, and how frequently do you send him financial information about your subsidiary?
Every month he gets the financials. Because this is Christmas season, on a daily basis he gets sales from all of our stores, our online business, every segment of C's Candy. So he gets the numbers. Anytime I talk to him, he knows the numbers, and he doesn't forget them.
So you would say he watches closely, even though you're autonomous.
He loves to watch what's happening in the business. He certainly understands the financials on a monthly basis and can very quickly get down to the meat and understand if there's any differences in there that he would want to talk about. But it rarely happens, and again, he is involved as much as he wants to be, but he understands the businesses in a way that most people wouldn't, because his mind works that way, and because he's so familiar with our business. He remembers at See's we have store numbers for every shop within See's Candy, and there's 225 or so of those now. And he remembers the shop number of any shop in Los Angeles that we currently have or had. And I don't know how he does that, but he does. And he will occasionally he'll pop the question: is South Coast Plaza still doing about X amount per year? As far as I know, it is. Let me check.
Now, Sue, you're on the audit committee of Berkshire.
Yes.
And another one of the things that Larry writes in his book is that the choice to operate in a decentralized manner from the beginning reflected a belief in the value of autonomy and a conviction that people properly entrusted with authority will generally exercise it faithfully. Now, kind of as Tom said, this is fundamentally different in a way from how corporate governance is today, where there's this sense of needing to have internal controls and independent monitoring. So what's the balance at Berkshire, and what's it like to be on the board and have to monitor something that is structured this way?
Well, it's, at the end of the day, although there are only 25 people in the corporate headquarters, as you pointed out, each of the subsidiaries has its own finance and audit functions, and those all roll up, to corporate. So corporate does have an internal audit function, and we get a report every board meeting, and it's actually incredibly useful. And of course, as a public company, Berkshire complies with Sarbanes-Oxley and all the other requirements out there. So we have hotlines and other ways that were there issues to materialize, they could bubble up. And sometimes they do. But one of the nice things about having such a decentralized confederation of companies is that there are many operations that aren't overly large. So if a problem were to materialize, in terms of materiality, it's not something that's been very significant. And for the very large ones, we pay more attention to those, and the ones that would require judgment and risk. I'd say that, as has become a legal requirement to have a risk management function within, which is the role of the board, actually sometimes delegated to the audit committee to review the company's procedures and controls. Warren and Charlie are probably the preeminent risk management officers. They are very adept at understanding risks that may materialize that others don't see, and they spend a ton of time thinking about that as they think about preserving their capital. So because we have a CEO and vice chairman who live and breathe that as their DNA, and because we have the normal controls in place at the subsidiary and then at the parent company level, my belief from the time I've been on that audit committee is that things do surface. Sometimes things happen, and as happens in any company, and there's a follow-up procedure, but it works really well.
Now, Brad, I want to ask you about the culture a little bit. Is the culture of See's and the other subsidiaries you've worked at, is that shaped at all by Berkshire? Or because they're autonomous, do they have their own individual culture? How would you describe kind of the culture? Is there a typical Berkshire subsidiary in your mind?
I don't think that there's a basic standard culture in all the businesses that would be similar, other than understanding, what that business is about and why, and what their charge is. Again, to provide a good return and make sure that we deliver for the shareholders, and that you conduct the business in a very sensible and ethical way. We're protectors of our brands, and protectors of the Berkshire brand. I think you would find that in every subsidiary, that they understand how important that is to us as a corporation, and that we execute that particular role all the time without fail. It's too important to lose your reputation, whether it's for that subsidiary or for Berkshire, and I think you would find that in every one of the subsidiaries, that we all understand, as Warren would put it, if the right way to do things is you envision a football field and the out of bounds lines are, if you go outside the out of bounds lines, you clearly are doing something wrong. And Warren's philosophy would be, we want to play down the center of the field within the hash marks. We don't want to get anywhere close to the out of bounds lines. You don't need to. Stay right down the middle of the field and don't even waver and think about going close to the sidelines, because we just simply don't need to. And for our reputation, it's best that we don't.
Now, Tom, speaking of reputation, how would you describe Berkshire's reputation, and what is the importance of that to its business success?
The one reputation that Berkshire has, I think, for me at least, would be the most powerfully communicated one, is the commitment that Warren makes when he buys a company, that he's not buying it to trade it. And I think that offers them all of the benefits that follow, because the type of seller of a business that he wants to buy is the seller who cares about what he built, the people and the brands and all of the interactions that are represented by that business that they lovingly built, and that commitment, which I don't think he'll ever break, that if they sell to him, they'll respect all of that, is enormously valuable. And I think the other reputation would involve sort of the ability to make a decision quickly. I remember hearing a story way back when about Warren going into a meeting to buy one of the insurance businesses that he acquired, and he shows up with nothing. And there's this investment banking team that has like stacks of pre-printed computer-generated what-ifs. And they go into the meeting, and this guy says it'll be extra this, and they have to go through the stack. And Warren says, fine. It's the complete knowledge that accompanies his decision, buttressed with infinite amounts of capital, that allows the decision to be made without a lot of bureaucracy. So a commitment that if you're going to deal with Berkshire, that there are terms that won't be breached, and that those terms satisfy the right sellers, and then there's the ability to make decisions and then have the availability to close. And that's built the business.
Now, Larry, you say that companies self-select for membership into the Berkshire family. So what kind of person sells his or her company to Berkshire, and what are they looking for when they do that?
Well, they are looking for a permanent home most of the time, and that the point that Berkshire has acquired 60 subsidiaries since it acquired See's Candy, which was the first or second one, and it has never sold a single one of those in 40 years, even if they struggle, as some of them do from time to time. And that commitment of permanence is, I think, the central value of Berkshire Hathaway. It's one of the reasons why I argue in the book that the company is built to last. The company is built to stick around. And Tom rightly suggested, sellers of businesses to Berkshire find that commitment extremely attractive, especially families who have built up a legacy and want to preserve the identity, entrepreneurs who are seeking security in the operation of their businesses through thick and thin. And all of the companies, many of the companies at Berkshire are what I call corporate orphans, companies that had been through a ringer, owned by private equity firms, through leveraged buyout operations, through bankruptcy. 7 Berkshire companies have been through bankruptcy. And managers of companies like that ache for a permanent home and ache for that autonomy that Brad was talking about. And so sellers of businesses who want a permanent home and who want to retain that autonomy find Berkshire extremely attractive. And not every seller will be like that, but many of them are. And those who want that kind of environment find it with Berkshire. And I mean, you asked Brad that question about what is the culture of the Berkshire subsidiaries, and it is surprising to see in this vast conglomerate made up of 60 or plus businesses, all in different enterprises, founded at different times, different sizes, and so on. There are a core set of common values that they care deeply, as Brad says, about ethics and reputation and integrity. And as Tom suggests, they're united by a sense of permanence, and they all believe in autonomy. And so that's what's amazing to me about the confederation, to use Susan's excellent term, at Berkshire Hathaway. They all look very different, but in fact, they're united.
Now, Sue, I want to ask you some compensation questions. So, Warren and Charlie, how much do they roughly make as the CEO and vice chairman of Berkshire?
Is it 100 or 200?
100,000.
100,000.
100,000 a year. So, and the CEO of someone, say Exxon Mobil, which is comparable in size, might be 20, 30 million.
Yeah.
And as a board member, how much do they pay you?
3,000?
Yeah, we don't even. probably mostly donated anyway.
But I get a giant box of See's candy every year.
It's invaluable.
That's the real thing.
At Christmas, and in fact, one of the reasons I came, I had to tell Brad I want peanut brittle this year, not the mixed candy.
And that's less than Intel and other boards would pay.
Yes.
And now the CEOs, the subsidiary CEOs, they get market compensation, salary, and a performance bonus that's based on achieving performance metrics. The bonuses are entirely cash, no stock options. Is that correct?
No stock options is correct, yes.
And so what kind of metrics are used for the CEOs? Because the CEOs who work in these subsidiaries stand to make substantially more than, in terms of salary, than the people running it.
Want to talk about yours? I'd say that
I'm still waiting to get mine.
Yeah. I think, well, first, like so much of Berkshire, it's really not uniform. It so depends on the operation, where it came from, et cetera. There may be an operation like Mid-American. Now, Berkshire Energy was not entirely purchased. Some of the equity remained with some of the principals who are still, one of whom is still with the company. So I would say that Warren works out an arrangement with the acquired company's CEOs or with the existing company CEOs that's relevant to that business. And the specific metric on which and targets that are crafted by him will vary also based on the economics of the business. What you might want to compensate people in the insurance business for would be a very different metric than it might be in a more traditional business that's not driven up its balance sheet as much. So but I would say that where there are longer term deals, it would be some measure of profitability on an after tax or fully accounted for costs and often capital costs over a multiple year period.
So what's kind of the importance of this compensation system where the people at the top make their money through their investment but not through salary, but the subsidiary CEOs have very kind of set cash bonus based on what's kind of the implication for the company?
The only thing I would just say that I don't know that we could say that universally what you just said is the way it works. I mean, I think what's important is that Warren works out an arrangement based on the industry in which the company operates and the performance of the business with each CEO. So some arrangements might be heavier on salary than a bonus. So it really depends. I guess I would see the importance being, well, one, it's very unusual in that you don't have a comp committee out there making a bunch of comparisons with other companies and all targeting like the 75th percentile, so the 75th percentile keeps rising because everybody's doing that. And I think Charlie's had some very acerbic comments about that approach. So it's really a very individualized approach, and it's very much, Warren is very involved with that. He sets them, and we at the board are not very involved in that. We're involved with Charlie and Warren, and they make it easy because they take $100,000 a year, and that never changes. So the compensation questions for the board are really not too important today. They could be important in the future because it's unlikely the next CEO of Berkshire is going to have the same arrangement that Warren and Charlie do today.
Well, let me ask some quick questions about succession, and then I'm just going to open it up here. Sue, can you just explain to people what the general succession plan is for Berkshire? What's going to happen to the company after Buffett's no longer there?
No. I can't expand too much on that. But I think what has been said, and I can corroborate, is that the discussion, there's frequent discussions in the board meeting about this. Warren's quite engaged in it. Just to pick up on one of Larry's comments, that I think he's said he's written a letter that starts out with the day after he passes, that starts with "Yesterday I died." This is unquestionably bad news for me, but not bad news for you. So it gets into he and we feel very confident, based on how he's run the company, that there are several candidates that could run the company if he were hit by the bus tomorrow. So we have a plan for that. But I would also say that just as how investments might have been handled 20 years ago before Todd and Ted had joined, who leads the company if Warren continues for the next 10 or 15 years and is as energetic and mentally capable as he is today. He just gets better and better. He's really a phenomenon, as is Charlie. Things could change there too. So it's a topic that's relevant, that we talk about, that Warren's very involved in, and I think we all feel really good about how many attractive candidates there are within the Berkshire fold, in part because of the way it's run and the enormous amount of business decision-making power that rests with the CEOs of all of the companies. In some ways, I don't know if you address this in the book, but the harder question is not so much the replication of the businesses themselves, but getting someone who can attract sellers in the same way that Warren has, and that can allocate the capital, because while the business is quite decentralized, the capital allocation is quite centralized. So that is, and so that's but the people that are in place right now are doing a terrific job, and Warren's really started to build a strong succession path there.
I just echo on that last point, that the idea of, I think the most important part of the succession plan, Sue has just hit on it, is making sure that the company will continue to attract sellers, so that there's a great place to allocate this capital, so that we can buy companies where the sellers who believe in permanence and autonomy will sell at a lower price to Berkshire than they would to private equity or to another conglomerate. That's the most important part of the succession plan. The personalities are important, but that's the most important part. And this is, I think, the ultimate achievement. The values that Warren has baked into the company that include this commitment to autonomy, that they do not micromanage Brad or anybody else, that they have never sold a subsidiary in 45 years, even ones that have struggled. And so long as the successors keep commitments like that, it will work. And I think the real danger to the company is activist shareholders who will pressure those successors to change that, to sell this subsidiary that's struggling and make a dividend, to tell this CEO to do better on this, that, or the other thing. So that's, I think, he's done everything you possibly can do to create an enduring company. And there will be pressures in the future, but I think he's done everything any human can do.
Right.
I was just going to put some numbers on that point. You opened with some numbers and showing the compound growth rates over, I guess, 30 years. So the market value of the company is around $360 billion now, and it's accumulated over the last 50 years. Berkshire just had its 50th birthday at close to 20%, fairly close to the 18%. If you fast forward and say, what's going to happen for the next 50 years? Probably in large numbers getting larger, it's not going to accumulate at that rate. But if you look at the difference between a 5% compound growth rate and a 10% compound growth rate. The difference in market value is $4 trillion at the low end and $40 trillion at the high end. Now, GDP today is $17 trillion. So now that's today, not 50 years from now. But the point is that for twice the growth rate, you get a 10x value difference over a long period of time. And that's the magic of what he's been able to create. So if you have businesses that collectively kind of grow in line with GDP at 5%, to get that extra 100 basis points, 200 basis points, 500 basis points, to get to 10% or higher requires strong allocation of capital. So it's very important that we get that right in the next CEO.
Great. Well, let me just read one quick quote here from Charlie Munger to see what his thoughts were. This was about 7 years ago. He was talking about Berkshire, and he said, "I think we're creating something that may be a learning exemplar for the world for a long time after the original people are dead. I don't think the culture is going to perish because Warren perishes. Sure, we will lose something we cannot replace, but there's a lot of durable good in Berkshire that he will leave behind. So how far can this Berkshire model go? The one we're talking about may have gone farther than any such system has ever gone before. It's worked amazingly well, and I think it can go a lot farther, but it's unknown territory. I always said that I wasn't sure how well I'd handle the aging process because I'd never done it before at this level, and Berkshire's in exactly the same position. So I don't know how far this model can go, but I think it can go a long, long way farther than it has so far." So with that, I want to invite people, if you want to come ask questions, we have microphones here at the front. If you don't mind coming down, please feel free to come down and say your question.
It's just a small amount. Okay, the gentleman said that in a recent shareholder letter, Warren indicated that on his death, he's going to invest some of his estate in the S&P 500, and he's wondering why wouldn't he just reinvest it in Berkshire? And I just clarify that virtually all of Warren's estate is going to be given to 5 foundations, including the Bill and Melinda Gates Foundation and 3 or 4 run by his family. And all of those shares will be sold gradually over a period that will take up to 10 years, or maybe even 13 years. And so you'll gradually have this shift from there being a controlling shareholder to a market ownership. There's a tiny bit of his estate that he's leaving for his wife, Astral, his second wife, Astral. And it's that part that he says to her, you should invest this in the S&P and not in Berkshire. And I think this is just a totally personal decision. It was a shareholder asked him that question at the annual meeting last year. And he said, it's nothing against Berkshire. It's just I want the peace and mind and security that my wife has the S&P, and I don't want to have to worry about that. And Charlie had a great quip afterwards that was, I think Warren has earned the right to do whatever he damn well pleases. But it's not a swipe at anything against Berkshire.
Yes.
I'm curious at the corporate board level, Warren's done so many things right when something hasn't gone right and it's gotten up to a board discussion for the future, whether it's something or something hasn't gone right as the board, where the board has to step in or help in those types of decisions when you have gone badly when so many.
I can talk about only the ones that I've been there for, and so probably the best example is the situation with David Sokol, in which he made a personal investment in a company called Lubrizol that he was introducing to Warren as a potential acquisition, and ultimately turned out to be an acquisition. And that investment wasn't disclosed, and it's against corporate policy. There's some questions later as it came out whether it's actually a violation of securities laws or not. But I was on the audit committee, so I was quite involved with that situation. And I would say that Warren was extremely forthright, very businesslike, and in fact, his position on it and understanding of it evolved over time. And in some ways, because Warren is so forthright, he wanted to communicate with his shareholders as soon as possible. And And so what that means is sometimes the communication might change, because in normal situations you learn more about a situation, and then maybe your position 2 months after something happened, as you understand it all, is a little different from when you first surface the facts, or what seems to be the facts. So I'd say, you know, he treats the board as, I think, his public persona is he really wants to get the information out there. I also think, you know, there's a lot of communication in between board meetings, and he will come for advice or a discussion with selected board members along the way, and is extremely he likes it when people tell him what they really think. So.
Right. Yes.
It's almost a follow-up to the prior question. So Warren Buffett is famous for his phrase that you make a good decision is when he looks in the mirror and then the decision is made. So given that Berkshire Hathaway has a very remarkable board, so would you comment how those two things go together, and what type of decisions he will probably never seek the input of the board, and which type of decisions he will never might just make by just looking into the mirror?
Well, that's a good question. I think I have to remove always and never from any of these questions, because it really is so case specific. But I'll say here's one that I was sort of surprised at when I joined the board, in the category of the board is not very involved and that is in very large acquisitions, we discuss them, often without a name. Often with sort of in concept, and then as it gets closer and closer to the acquisition. But I sheepishly, in one of my first board meetings, I read the bylaws, and I sort of thought, you know, because he announced that he had made an acquisition, I thought, well, you know, what's the threshold? Because at the company I worked for, other boards I've been on, you know, there might be a certain threshold of, making this up, 50 or 100 million for internal investment, or you might have an audit committee or an investment committee of the board requirement for 500 million. You might need the board for $1 billion. You know, depends on the company. And I said, you know, I must have missed it, but what is that? And he just leaned back and laughed, and he said, you need to devise that for the next CEO. But so that's an example where he has retains the information, and in part, I think it's a philosophy of, you know, his deals get done pretty quickly, and he doesn't want information to leak to the market. And because he is as strong a deal maker as anyone on that board, there's not a heck of a lot of value added from the board on that particular issue. So different from other companies, I'd say the board is less involved in his acquisition decisions. Now that's at a deal level. Often as an idea of a deal, what business it's in, he'll definitely call and brainstorm and loves to have discussions about that. But so it's sort of the opposite of the other boards I'm on, where you get the deal when it's all fully baked and go through an approval process. He involves the board more on the front end of it in selected cases, and many he doesn't. The second one, what would he always go to the board for? I mean, certainly anything compliance related that requires approval of the board, follows the letter of the law. Outside of that, I don't know that I could pick one thing that he would always go to the board for. He really relies on different members of the board for different perspectives based on his history with them, based on what the board member might add. And so it's hard for me to put a cookie cutter approach to that. Does that make sense?
Yes.
Well, the first thing we should all remember is that Warren's got at least another 20 years in him. So I felt a little funny doing this book. I asked him, you know, would you mind if I write this book? Because I remember how Charlie felt, you know, 20 years ago, and he said, no problem. But I did feel a little funny doing it. And so my prediction is that on his 100th birthday or thereabouts, I think the Class A will cross the $1 million threshold, and then maybe we'll get that letter. But no, I mean, the argument that I make in the book is that through a process of selective acquisitions, of finding companies that have cultures that fit in with this family, and then as they become members of this family, there's an iterative reinforcing process of cultural sustenance. That's sort of how it has worked. And so long as everybody in the family embraces these values and doesn't deviate from them, it's almost self-sustaining. I mean, people can screw it up, but the culture itself is surprisingly strong and durable. And there have been cases where leaders of some of the subsidiaries strayed from these values, and they had to be replaced. And so this autonomy principle is extremely important and valuable, but doesn't mean people are free to depart from commitments that Berkshire has made or values that it believes in. So recently in Benjamin Moore Paint, when Berkshire acquired that paint manufacturer and retailer in 2000, Warren made a personal commitment to that company's distributors that it would continue to distribute through them. These are mom and pop shops across the country, rather than through big box retailers like Home Depot and Lowe's. That's a very difficult business model to sustain these days, given the power of those big retailers. And a couple of CEOs at Benjamin Moore in the past 5 years were about to break that promise and hadn't reported it to Warren. When he found out about it, those fellows left. And now the current CEO, Mike Searles, is committed to that model, committed to keeping that Berkshire promise, which is so valuable. And he's turned it into a competitive advantage by saying, look, we're the only paint manufacturer retailer that's selling through the old-fashioned distribution network. So he's working that. And there's 6 or 8 examples I give in the book where somebody goofed up. And so you will need a CEO who's capable of doing that kind of thing. But I think there's obviously still some human agency. And as Charlie says, Warren's not replaceable. But as so much as humanly possible, they've created an enduring institution.
The culture also, becomes harder to sustain as the scale grows. I mean, the business is now so much larger than it's been. And Charlie, at the annual meeting, maybe this year or the year before, said that we have to not forget that the models that make a company great may not be the same ones that will keep it great or allow it to become more great. And so he's clearly thinking about ways that the business will have to evolve. And from my perspective, at least, I would think that on 2 fronts, it might be quite different if Warren were to pass. And one would be the dividend. And though Larry says in the book, his book, which is a great read, that Warren's stock may stay tied up in an estate for as much as 12 or 14 years. That surprises me. So I'm not clear on that. I would have thought that there would have been a sooner transfer of the shares to the foundation. But in any case, the foundation will have a spending obligation that could be met with a very high dividend from Berkshire, because as a foundation, you have to distribute a certain amount over 4% to qualify over time. So a large dividend would help relieve some of the burdens on the business. And at the moment, we're probably not going to get a large dividend, because that would mean that Warren would receive a large dividend. He doesn't want it. But one way in the business might change and relieve some of the pressure on the culture because of the burden of deploying so much capital will be to step up with a very large dividend and use it to help the business. And similarly, a large share buyback. Both of those could address what might be a pressure point for the culture going forward, which is how do you deploy that much money?
But I think ultimately to me, the answer to your question is the magic of the returns has been in this collection of businesses. Some of them generate more cash than they need, and others consume cash through capital, like Burlington Northern and a few others. And so to have a tax-free transfer of capital from businesses that don't need them into businesses that do in a compounding fashion is a critical point of the returns. It's also critically important that the businesses managers are operating so well, as Larry talked about, and Brad and Tom. But at the end of the day, and that's critical, that's a need to have, but the want in order to get the kinds of returns or even lower but still very attractive returns it's very critical that the cash generated from the businesses can be reallocated. If in fact that's not the case, then the board at that time will have to consider some of the other ways to return cash, such as a dividend or a share repurchase. But I think the board's pretty committed to trying to keep that magic going if we can.
Well, I'd like to
I'm
Just
going to take.
add on that.
We're going to
Let me,
take.
can I
Oh,
add
sorry.
on
Yes.
that? You know what? There's a lot of discussion about what will happen at Berkshire and how will this continue and what will the culture be and those kind of things. And I can tell you that my job doesn't change the day after Warren passes. I have the same job, same responsibility, the same duty to the shareholders. So for those of us who are operating the businesses, that doesn't change. Now, those questions on, more generally about the Berkshire culture and what should happen or what may happen and those kind of things, I feel fairly certain that with the really intelligent people that we have on the board and with Warren himself, there's not a question that anyone in here could raise that they haven't already thought about and spent a lot of time thinking about it, because their interest is exactly that, to solve every problem that could possibly come up. And Warren is really good about thinking about those things and understanding the what ifs and how do you stop the what if from happening. And you're in the board meetings.
I'm so glad you're so confident.
I am.
I'm very confident.
Yeah.
Well, we're going to take a few more questions. I do realize that we've hit our time, so if people need to sneak out, please don't feel shy or embarrassed about doing so. And if you want to stay, we'll take a few more questions. Yes, in the back.
Is that for me? I think that, I think it's kind of consistent with the perspective that Warren tries to work with management teams in trying to come up with the right solution to a problem, and to publicly vote against it is a pretty major statement by a shareholder. So reserving or withholding vote is also a strong statement. I will say that, as has subsequently come out from the head of the compensation committee at Coke, really bright woman, went out and with the backing of the Coke board, got information from all of the largest shareholders about how they feel about the compensation plans, and spoke directly with Warren about it. And he said to her, if you were a private company, is this what you would do? Look at all this Black-Scholes, all the stuff that the comp consultants talked to them about. And I think Coke came back and very thoughtfully revised its compensation plan, reduced how much equity, and instituted a more performance-oriented component to it. And then she, wrote a letter and publicly put it out on the Coke website to communicate directly with shareholders. So I think that, to me, is sort of a case study in that initially, I think I understand why there was a reaction like, wow, this is something that you are principled about. How could you have not made a big statement? But he did make a statement. He just didn't do it all over the Wall Street Journal. He was very active with Howie, who's on the board, and with the company, and was open to meetings with the board, and they came to a solution that was better for shareholders. But that is kind of what happens in management. It doesn't always happen the way a shareholder might think. They immediately see something and say, oh, this is awful. Sometimes things take a little bit of time in companies to solve, and some process happened, and it did get solved. So from my standpoint, it's, he didn't need to take a big public acrimonious statement in order to affect change, and change did get affected.
I would just observe the enormous investment that Berkshire makes in technology to enhance the business. So you think about Burlington and the level to which it operates today. And that's harnessing the power of technology. I just read a great write-up in Ad Age about Pampered Chef, who now has mobile hand units to try to facilitate the ordering process. And they're great users of technology, and they make their businesses run better with the benefits that accrue. And the only foray into technology itself has been IBM, which is a not a bleeding cutting edge of technology, but it's in theory something that can be managed profitably over a long period of time, given its brand equity and its high switching costs. That would be the argument there. Beyond that, I defer to the people inside the company. Technology.
I have nothing to add.
Okay, Charlie.
Are you going tech? Are you going tech?
Yeah, I don't have. I'll adopt Charlie Munger's line of not having anything to add as well. But I will say I think an interesting observation is when you look at the top 5 most valuable companies in the S&P, Apple, Microsoft, and Google are 3 of the 5, and Berkshire has created the value it's created without having invested at all in that sector. And that's a sector that's done extraordinarily well. So that makes it even more remarkable from my perspective about the value creation. And it shows that with good, solid businesses that are growing at a reasonable rate and reinvestment of the cash, great returns can be generated. I think Warren has said, well, why he doesn't. He's interested. I mean, Bill Gates is on the board, who you know his history, and I come from the Yahoo background, so he's very interested in these topics. But he's increasingly convinced he doesn't care. Is that those are outside his circle of competence, and that the obsolescence and the massive market share shifts that can happen is not something that he feels he can evaluate the moat effectively with. So, but nevertheless, where tech has been, you saw oil as the top stocks in 1984, whatever. It hasn't invested a lot in that either. So it's kind of incredible the returns that have been generated without investing in technology.
Anyone else? No, this is, sir.
Berkshire invested he said, can everyone hear that question? I mean, during the financial crisis, Berkshire of 2008, in the 3 weeks after Lehman failed, Berkshire Hathaway invested $16 billion in various securities, mostly preferred stocks, often convertible, of companies like Goldman Sachs, Bank of America, even USG, United States Gypsum, and the question is, well, it wasn't Warren as a person a big part of that? Weren't they going to Warren Buffett rather than going to Berkshire Hathaway? And so without Warren, Berkshire's not going to have that advantage. And I think there's obviously a huge amount to that Goldman called Warren Buffett rather than Berkshire Hathaway. But I think they went to him for reasons that are now identified as Berkshire culture, that autonomy. They knew with Berkshire Hathaway and Warren Buffett, they weren't going to be told what to do. That if Goldman they'll have a quiet investor, and Bernanke and Lloyd Blankfein can run his business the way he wants. It's not going to be Carl Icahn telling him what to do. And likewise, that idea of, and it's Stu's point in the Coke case, that you're not going to find an activist shareholder trying to tell you what to do. So, and likewise, that sort of commitment of permanence, that we're going to own this security until it matures or until we convert it or until the fundamentals erode in some serious way. So you don't have to worry about us flipping to Carl or Nelson Peltz or some other activist shareholder. And so Warren's personal identity had a huge amount to do with that, but Berkshire's institutional reputation and these values will continue to make it an investor of choice for very many ordinary companies just ready to sell, or companies in crisis desperate for capital.
Okay, let me take one more question, and then if people have others, feel free to come down afterwards and ask directly to any of the panelists, please. Yes, sir. In the back, sorry. Okay, line them up.
If you only have one, I'll take you.
Great.
30 seconds or less.
Okay. Yes, I have solicited Warren's advice on different issues with the businesses that I've run, and I can tell you, he again, he just understands our businesses in a very detailed way. So the advice that he gives or the opinions that he gives come from a perspective that is very solid, and yet it's up to me in every situation to agree and take his advice, or decide to move on my own and not. So that's just the way we work.
I would say, I think there probably are companies out there that are, at least in acquiring industrial and sort of mainstream American old businesses and reallocating capital. I think there are businesses out there and funds that do that. Marmon was a company that the Pritzkers ran that had it's not 100% similar, but had that sort of operational and investment profile. What's, I think, different about Berkshire, and part of the reason it hasn't been replicated, is one, the longevity of Warren. It's not too many people who, from their early 20s until they're in their early 80s, are working at the same thing just as hard. And in the last 15 years, and certainly in the period in which I've been associated at an inside level with the company, the role of the size and scale of the acquisitions are much more significant than in some of the prior years as the company's gotten bigger and the capital's grown to support that. So, and then the power of compounding. So if you think about those returns over that period of time, you've got 50 years of history and exponential returns relative to a business that where an operator might do it for 10 years and then retire 20 years. So I think that's different. And then the other thing, the public nature of it, he likes the platform now. He likes to talk about it. He likes to, uses his annual report. He uses these annual shareholder meetings, which now are 40,000 people. And so I think there's a marketing element to what he does that's probably different from some companies that might be accumulating value in a similar sense. So you might hear about it more just because there's more value created over a longer period of time, and it's a very public approach to his shareholders.
I agree entirely. And I just add one point. I explore the Marmon Group a bit in the book, and I mentioned a few other companies that are doing it Berkshire's way. My favorite is Merkle, which is a third-generation Richmond, Virginia-based insurance company that whose portfolio since 1995 has tried to do exactly what Warren has done. It's run by a guy named Tom Gaynor. He's the president and chief investment officer. You probably know Tom. Yeah. And he's got a mini Berkshire. It really is a mini Berkshire. It's a public company. He writes a great letter. I mean, he's consciously committed. I mean, he's still himself. That's an important part of it. He's not really trying to be the Oracle of Omaha, but thinking about these kinds of values and using insurance company float to make to fund acquisitions at a relatively low cost with prudent underwriting. So I think you're right that it's a good thing to test, but there are people who are seeing value in it.
So I have the final badder question, which is what's it worth? I will go to the annual report and this past year's annual report and just highlight a couple of points. Then I'll give you a reassuring sense that I believe the shares are still worth more than the share price, even though the share price has advanced so sharply in the last 3 months. But what Warren has done in the most recent annual report, he spent a lot of time describing, in one instance, how a business that appears in the books at a certain value is worth considerably more, and that would be that would be Geico. And he talked about Geico, and he talked about the fact, well, it is C's. But in addition to C's, sorry, it's Geico. And he talks about the fact that they've taken their insured from 2 million insured when he acquired full control up to over 11 million now. And then he ascribes a certain lifetime value to each newly acquired insured, and the difference between where he started and where he is now relative to the intrinsic value per lifetime value of insured is $20 billion. That doesn't appear anywhere. Right. But since Warren has said that he's in the active business of trying to buy back his shares, he feels he has a fiduciary duty to help the investor understand what that intrinsic value might look like and how you might attempt to derive it. Well, book value doesn't do any kind of a job whatsoever, because that $20 billion that he ascribes to Geico doesn't appear in book value. It doesn't appear anywhere other than that's what you have when you have high persistent, highly profitable insureds rolling over each year for the duration of their insured lives. So he provides us with a sense of just how meaningfully above reported book intrinsic could be in just one instance alone. I'd say that the margin of safety's come down because the shares moved up so much in the last 8 months, but it's still, I'd say, north of 250, and the shares are now at 230 or something like that, maybe higher today.
It reminds me of when, in 1982, you thought the price was too high, and now you're still buying?
It never stopped. But, yeah, it's and partly because of what we've talked about. It's not a static number, and you have to be careful not to pay twice for something, but the ability for it to continue to grow by offering the virtuous home for people who are selling great businesses and the structure that keeps working means that you have the chance of it growing meaningfully from here. So the estimate that you're looking against still has the ability to advance, and it did starting in 82, and it still has. So,
well, with that, I want to thank you all for coming. Please thank our panelists for taking the time.